How accurate is a Monte Carlo simulation? Have you ever wondered how traders predict the future movements of stocks and options? One popular method they use is called Monte Carlo simulation. But just how accurate is it? Let's break it down. Monte Carlo simulation is a technique that estimates the value and risks of financial instruments by generating many possible future price paths for an underlying asset. The idea is simple. The more simulations you run, the closer you get to the true value of an option. This process is known as convergence. However, accuracy is not guaranteed. One major limitation is that running a Monte Carlo simulation can be quite resource-intensive. To get reliable results, you might need to run thousands or even millions of simulations. If you only run a small number, the results can be erratic and may not truly reflect the option's value. This is particularly important in options trading, where rare events, often referred to as black swan events, can significantly impact the outcomes. Another factor that affects accuracy is the quality of the inputs used in the simulation. If the assumptions about volatility, interest rates, or other market factors are incorrect, the results will also be off. This means that even a well-structured Monte Carlo simulation can produce misleading results if the underlying data or assumptions are flawed. To improve accuracy, traders often use techniques like antithetic variates. This method generates pairs of price paths where one is the mirror image of the other. This approach helps to reduce overall volatility in the simulation results, making the process more efficient and less sensitive to extreme values. In practice, Monte Carlo simulation is often compared to other pricing methods, such as the Black-Scholes formula. For standard European options, both methods can yield similar results when enough simulations are conducted. However, Monte Carlo simulation shines when dealing with complex options and scenarios that other methods struggle with, such as options with multiple underlying assets or those that depend on the path taken. Despite its flexibility, Monte Carlo simulation has its limitations. It often fails to accurately capture the probability of rare, extreme events, which is exactly what options traders need to be aware of. While the method can simulate a wide range of outcomes, it may underestimate the likelihood of black swan events unless it is specifically designed to account for them. In summary, Monte Carlo simulation is a powerful tool for options pricing and risk management. However, its accuracy hinges on the number of simulations run, the quality of input data, and how realistic the underlying assumptions are. It is best used alongside other risk management techniques, especially when considering the potential for rare but impactful market events. Understanding these strengths and limitations is essential for traders looking to make informed decisions.